reports, both on the unemployment claims, which suggest that they're not as bad, that there may be more of a seasonality element to it. And also the jobs numbers are being questioned as being particularly weak because of hurricanes and so on. And maybe next month's job numbers will look strong. Finally, you see the consumer is still very strong in the U.S. Sales growth was, the last numbers were 1% monthly. And that's suggesting that the third quarter in the U.S. is also going to be a strong quarter. So the recession fears have waned a little. At the same time, one of the big concerns, which we probably will come to, is that the global carry trades, which were responsible for investment in a bunch of countries, was coming under question because the currency that was being borrowed in, the Japanese yen, was not only getting stronger as a result of Japanese monetary policy, but there was a sense that these carry trades would have to be unwound at a loss. And what's happened is the Japanese deputy governor came in saying, don't worry so much, monetary policy will adjust to the state of the markets. All this combined to shift the markets 180 degrees.
But do you think the peril still hangs that the Japanese central bank may yet hike once again? Or do you think, having learned its lesson, we are not going through this kind of attention anymore?
Well, I think it's the wrong idea for the central banks to be supporting markets. I think that we are where we are, but the Japanese central bank should be talking about inflation. That's its mandate, and it should be focused on that. And one of the dangers in Japan is really that interest rates have to go, real interest rates have to go really high. It has an enormous quantity of debt outstanding, and that is going to create enormous problems for government finances. So they have to be very careful to let inflation not get out of the bottle they have it in, which means that they have to be focused laser-like on controlling it. So if interest rates have to go up, they have to go up, but that'll prevent it from having to go up yet further, which may create more financial, fiscal difficulties for the government.
Okay, so to come back to the US economy, before I speak about markets, what is your own sense, looking at all the data? You think the US is in for a serious slowdown, or is it still a very robust economy?
I think the name of the game here is uncertainty. Okay. That in the short run, there's enough good news and potential bad news that the Fed is actually right in its saying that we are data contingent. And I suspect that in his Jackson Hole speech, Chairman Powell will try not to lock himself into a course of action in September. The prediction is there will be a cut, but the question is how big a cut. And a lot of that depends on the jobs report for the month of August. If that is stronger because there were aberrant details in the July report, then the Fed may feel that it has more room, and as a result, the cut will probably be a 25 basis point cut. If, however, it turns out to be as weak as the July report, then the Fed will feel more compelled to cut. The point here is that it's anybody's guess how the economy is evolving, because there are forces on both sides at this point.
So if I ask you to wear your central banker's hat and sit in the FOMC or at Jackson Hole and make that speech, what would you say? You would leave it uncertain?
Yeah, to paraphrase Dr. Reddy, masterful uncertainty is what I'd leave it at. Okay. I wouldn't try and guide the market more than I have to. Part of the problem, Lata, is if you look at financial conditions, which reflect how tight the Fed is, yes. One measure of financial conditions is the Chicago Financial Conditions Index. That today is at its 21st century average. In other words, financial conditions are not tight. Okay. And the last thing the Fed wants, as it is trying to soft land the economy, is the economy takes off again, because the Fed has been overly sort of aggressive in promising rate cuts, and financial conditions weaken, you're already seeing, as I said, the consumers is spending and spending out of savings. So it's not that the economy is particularly weak, and I think it's the last thing the Fed wants to guide the economy into yet more sort of aggressive spending. So I would not try and guide at this point and say we're waiting for the data. If it slows down too much, we'll do what is appropriate.
Okay. Masterful, what did you say? Masterful uncertainty.
Uncertainty about what I propose to do.
Okay, fair enough.
As opposed to masterly inactivity, I think that was the other.
Okay, well, there is masterly inactivity from the Reserve Bank at this point in time, and I will come to that in just a minute. But to complete the global picture, if there is a serious global slowdown, it will impact, emerging markets like India, which are at the moment doing well on growth. What's your sense? Do you think the Chinese slowdown is serious? Or do you think, the globe is not in that bad a shape and India need worry about that part?
Well, I think we should always be worrying a little. The Chinese slowdown is serious. It's a structural slowdown because their basic sort of growth supporters, the real estate sector is in deep trouble and still hasn't found a bottom. So there will be price falls are significant. Since 2021, housing starts are down 65%. So this is a economy which depended a lot on construction. That has been taken out of the equation. Now it's overly dependent on exports. And of course, we have a lot of noises about what might happen next in the US presidential election. If Mr. Trump gets elected, then you're going to see serious measures taken against Chinese exports. And of course, once it becomes hard for China to export to the US, it sends its exports to other countries, including Europe, which are going to sort of stand up against those also. So China, I think, is in serious economic difficulty. And the measures so far haven't proved particularly supportive. They're in the right direction, but they haven't helped because the primary engine, the real estate sector, needs a deep fix, needs to find the right prices to stabilize, and that may be some way off. So I think with China slowing down, the West, Europe is, Germany is still the sick man of Europe. And it needs, it will probably grow at a relatively moderate pace once again outside of Germany. But the big issue for Europe is that inflation is still out there, and services inflation is still strong. So yes, the ECB will cut, but it will cut at a moderate pace. And so that leaves the US and Japan somewhat. Japan is picking up once again. But Japan has to figure out how it manages monetary policy going forward. So all said and done, the uncertainty for the world still exists. I think the growth numbers for the US this year, again, are much stronger than its potential, which means that it is still the biggest engine carrying the world economy.
Yes, US exceptionalism, as they call it, continues. But just to round off and to take the point that you made, how worried should we be about November 8th? Do you think that there is a real possibility of a Republican victory? And if that happens, just what should an emerging market like India be prepared for? Big tariffs, and therefore what for us?
Yeah, I think that the polls probably break 50-50 still. And, maybe 52 Kamala, 48 Mr. Trump. So it's, it's very, very close still. And who knows what will happen between now and the election. Already so much has happened, including the assassination attempt, which boosted former President Trump's numbers quite a bit for a while. So I think that we should be careful about possibilities. If you listen to the Trump advisors, they offer a scary vision of global trade, that 10% tariffs across the board, They're going to have 60% tariffs on Chinese products. And even these transshipments, which are evading U.S. Going into the U.S. via Mexico or Vietnam from China, they will be singled out and arrested.
Yes.
So the advisors are not just anti-trade, broadly speaking, but they're also very much strategically anti-China. Now, that offers both threat and possibility for India. Possibility in the sense that the China plus one, investment possibilities will become even stronger if a Trump administration comes in. The threat that any country that suddenly sees exports rising may attract the attention of the administration, no matter friend or foe. The former Trump administration didn't suggest it was differentiating between close friends like Canada and the rest of the world. So I am not sure that we should be celebrating entirely, but I think India should be quite careful in seeing if it can navigate to its advantage without, it's in nobody's interest to see a large country like China excluded from global trade. So we certainly should speak up for global trade, but where we can pick up investments, we certainly should clear the way for those investments to come to India, which almost surely means improving the environment for foreign direct investment, which has been languishing.
Oh, fair point. We would all be advantaged if trade was normal. But just to wind up this discussion on the global ambience with respect to India, do you see, therefore, a huge Chinese-led disinflation? It's already happening. US has, the European Union has already imposed close to 35% tariffs on a bunch of Chinese goods, including EVs. Indonesia, when I last heard from the South China Post, was contemplating 200% tariffs on some Chinese goods. So, should we be prepared that there will be a huge Chinese flooding if there were a Republican victory?
I think we should prepare for various alternatives. It may well be, and let me throw this out, that the Republicans, once they gain power, if they do gain power, will be a little more circumspect about what they do. President Trump is a former is still a business person, and does care about what markets do. If the idea is there would be significant high tariffs imposed suddenly, it certainly will affect U.S. business also significantly. And that might then create stock market reactions, which feed back into the administration, and the administration revisits its plans. So, a lot of possibilities exist. I think as with all business, it is prepare for the worst, but hope for the best.
Yep. Yes, election sloganeering and policy are two different animals altogether. And perhaps we may not see as much of a party manifesto getting translated. A very quick break, Dr. Rajan. Back in a minute with lots more questions, especially about India. back to this very special edition of Indianomics with Professor Raghuram Rajan, the former Reserve Bank of India governor. Dr. Rajan, thank you very much for your patience. Now, to come to the Indian scene, do you think India will be overly influenced if there is indeed, 3 Fed rate cuts in 2024? JP Morgan even believes it could be 5. I think so does Citi. So if there are an outsized number of cuts, do you think the Indian Reserve Bank can duck despite it saying that it will be guided by domestic issues?
Look, I think India is a continental economy in the sense that much of what goes on is not directly influenced by trade. It's not a small open economy now. It's a big, continent-sized economy. And so the external sector plays some role, but not the most important role. So I think it's appropriate for the Reserve Bank to be focused on more domestic conditions. It helps that, from the perspective of interest rates, Indian interest rates will look much more, healthy relative to foreign interest rates if the Fed has started cutting significantly. And that, of course, given global interest rates play a role, will give the Reserve Bank room. But it'll have to make that decision based on how it sees inflationary conditions within India.
Okay, I'm coming to that, but I just wanted to tell you that last week on Independence Day, I spoke to Dr. Rangarajan, and we were speaking about how he gave the Reserve Bank more elbow room in 1991, took a marketization of the exchange rate. And he said that the true independence of the Reserve Bank and monetary policy came in 2016 when we put in the inflation targeting framework. He said, neither the finance minister nor the governor can decide what the rates are because it will be decided by the committee and it will be guided by the inflation numbers. You've watched it for 2 sets of external committees. The latest one finishes its term this month. Are you happy with the way it's worked out? Do you think we've done well on inflation?
Well, I'm biased, right? I negotiated the inflation targeting regime and put that in place, and it started with my successor. I think it was a reform which was much due in India because it gave the markets, it gave ordinary people a sense of what the Reserve Bank was trying to do. And that commitment to keeping inflation within the band, which we arrived at before inflation targeting set out so that we didn't have to subject the regime to uncertainty about whether it would be able to achieve the band. It started within the band, and that was good. I think the idea was that that would allow India to actually be more flexible in times of difficulty. And I think that has proven right that during the pandemic, for example, when tight policy was not appropriate, I think it gave the Reserve Bank the leg room or the elbow room to keep rates relatively mild, keep liquidity conditions relatively mild, so that we could weather the conditions in the pandemic a little better. Now, if there was no certainty that the Reserve Bank would be bringing in, going back within to the center of the band, then perhaps there would have been more pressure both on the on inflation, but also on the exchange rate. So I think it's worked well. I think you would see, and I think there have been studies on this, that inflation has been much less volatile than in before we instilled the regime. Of course, there are other factors responsible also. But during the great moderation in the rest of the world, India still had relatively volatile inflation. So the fact that we've kept it within the band for the most part during this period, I think is good for the Indian citizen, good for the Indian consumer, and good for Indian business.
No, in fact, there were some finance experts, bond dealers, who said that it is partly responsible for us getting included even in the bond index. I mean, of course, fiscal rectitude, all that also mattered. Actually, if I can develop on that point, we now have a large amount of long-term savings. Insurance and pension fund kitty is about 115 trillion rupees. Just a little behind the bank deposit kitty of about 210 trillion. But, the short point is with bond index inclusion, we have a lot of money chasing government bonds precisely at a time when the fiscal deficit is coming down. But the insurance guys are afraid to put it in insurance. What would you suggest should be the big reform that will allow the corporate bond market to evolve and guide the insurance money into, infrastructure and such long-term things? We don't seem to be able to make that leap.
We need a very clear prudent man rule with safe harbors. What do I mean by a prudent man rule? It should give a insurance company which is investing money, or a pension fund which is investing money, a safe harbor. You can invest thus and such amounts of your portfolio in riskier investments such as corporate bonds. It doesn't have to be only in government bonds. And you can even invest in private equity, venture capital, and so on. Of course, there has to be a process of monitoring those investments so that they don't go completely off track and to your friends and neighbors. But countries have achieved that kind of checks and balances. This is for the companies to put in place.
Yeah,
but
actually,
I think there should be.
Yeah, they have been given a 15% limit. But insurance companies are not using that 15% simply because you're not very sure that, beyond AAA, they will get their money back.
That is precisely where there should be, steady guidance from the government that it is okay, that you will not be hauled up. But, these are the kinds of instruments you can invest in. And I think it's a matter of them getting comfortable, the monitoring processes getting better, and over time, them moving. Now, the government cannot say, you shall invest thus and such percent by thus and such date, because then that will create problems when losses show up.
To be fair, they aren't doing that.
I agree. What I'm saying is that is what the government is doing is appropriate in guiding them towards larger numbers. And, there should be moral suasion rather than regulatory compulsion to move towards those new numbers. I think as they get more comfort, some of them will start moving. And as they show success, as their relative performance improves, I think others will move. So I think this should be allowed, the leeway should be allowed to firms to do it. But the regulatory conditions should be clear.
Okay. I shouldn't have gone into that detour. Let me get back to the budget. The budget had a very refreshing focus on employment. Do you think that was a scheme whose time has come? Did you take a look at those schemes?
I did. I think that, it certainly is a consequence of an election where jobs was a huge issue and had been dismissed for long by the government, pointing to unemployment statistics, which are unreal. I think we should wake up to the fact that employment is a serious issue. Just read the newspapers and you see that it's a huge problem. Forget the bad data we have. I think almost surely this points also to the fact we need much better data. Monthly unemployment numbers should be produced by the government so that we have a good sense of where it is. Otherwise, you have policy making in the blind. But given that, I think this is a timely recognition. The key question is it enough? Is it too little? And that the proof of the pudding is in seeing how these work out. We need constant monitoring of whether, in fact, they're producing the jobs. Too much of Indian policy is, you fire and you forget. You have a scheme and you don't see how it's doing, and you say we had this scheme and it touched so many, crore people. But did it actually do what it was supposed to do?
Yeah.
And so what I would love to see is each of these schemes has a monitoring process associated. Today we have the data to see, who gets into jobs.
Yeah.
We can track them. How long do they stay in jobs? How much more salary did they make? And of course, we don't need to publicize this, eliminate data privacy, but the government can publicize aggregate figures. And for this, we need independent agencies which will do this and therefore not be subject to, accusations of bias. I think each of these schemes is worthwhile to monitor. Is it too little? Should we increase the quantum? Should we increase the kind of resources the government is putting into these schemes? So 3,000 towards pension sounds like, small amount of money. And will companies react, if that is the offer the government is making? Or does it have to be a different kind of scheme? So I would love to see, both these schemes implemented, but also constant monitoring to see if they work, and more if they don't.
Actually, we don't know because the fine print and the details aren't out. But actually, Dr. Rangarajan put it very well. He said, jobless growth is bad, but jobs without growth is also not sustainable. So finally, a growth question. We have managed, I think this year's guidance from the Reserve Bank is 7.2. Even if we make it to 7, it's a damn good number given the context. Do you think you're confident about the growth? And yet there is this core inflation which is going below 3%, which seems to give some doubts about whether the growth is good enough. Your thoughts finally?
Well, I would not focus too much on, what those growth numbers are. It's important they look healthy. But I would look at the quality of that growth, and that is why the jobs issue becomes really important. We've had a very capital-intensive growth in our manufacturing sector. If you look at the segments of the IIP that are doing particularly well, they're typically the more capital-intensive segments, and the labor-intensive segments are not. And we have to ask why this is the case, especially if, as we talked about in the early part of the program, we are getting the China +1 flows. Why is it that they're not creating many more textile jobs, many more leather jobs? What is it that we need to get that joblessness dealt with? And so I would focus much, much more on growth quality. But also, I would focus on creating the foundations for strong, sustainable growth in the future, which means much more investment in education, skill building, healthcare, so that our human capital is ready for anything, no matter what happens in the globe, whether it creates, new opportunities in manufacturing trade or new opportunities in service trade. We have to be much more flexible given the uncertainties in the global economy, and that requires investment in our people. I would like to see much more of that, which will help us grow in a much more high quality way.
Okay, well, there are programs on skilling, but we are out of time in terms of discussing that. And of course, even the fine print isn't out. That gives us a reason to invite you yet again, Dr. Rajan. Thank you very much for sparing time for us today.
Thank you.
Well, that's it on this special edition of Indianomics. Thanks much for watching.